The world is objectively getting warmer. In 2024, Canada experienced more heat waves than the previous year, with climate change making them more likely to be severe or extreme. July 22, 2024 was declared to be the hottest day on record globally. And over the past year, 10 countries reported that at least one day exceeded 50 degrees Celsius. We know extreme heat can lead to costly, destructive, and devastating wildfires. It can cause a spike in heat-related illnesses, and it can run water sources dry. In the US, heat is likely costing businesses $100 billion annually.
Rather than any moral responsibilities or social responsibility, focus for firms should indeed be fiduciary duty. So to the extent that they owe their shareholders a sound financial management, it is really important to consider these risks as they seem to be financially material. There should be a self-interest of firms in better adapting to these types of hazards just for the sake of their shareholders. My name is Nora Pankratz. I'm an assistant professor of finance at the University of Toronto, and I research corporate finance with a focus on the potential effects of climate change on firms and financial markets.
Nora has specifically been studying the impact of extreme heat on companies' financial success, and the signs are worrying. Businesses aren't unaware of this. One survey found that 56% of company leaders in Canada are concerned about the impact of extreme weather on their overall profitability. But how worried do they need to be? And importantly, what can leaders do about the risks of rising temperatures? Welcome to the Executive Summary. I'm Megan Haynes, editor of the Rotman Insights Hub. We know heat, in particular, has a profound effect on the overall environment. But what does it do to a company? A lot of the risks come down to productivity.
When I started to work on this, I had seen experiments on how heat affects our productivity that were conducted in the lab. So in these experiments, the researchers essentially heated up a room and then measured how these different conditions affect task performance. They found that as humans, our highest productivity, if we think about our work in office environments, around 22 degrees Celsius. But then they found that the task performance starts to decrease with temperatures above 23 to 24 degrees, and that there are pretty sharp drops in performance when we reach temperatures of about 30 degrees Celsius. For temperatures over 30 degrees Celsius, the performance drops by about 10%, keeping everything else equal. So I found this result really fascinating and then asked myself the question, okay, so if heat is bad for individual performance, can we also capture that at the firm level?
To study this, Nora gathered performance and stock return data from about 17,000 firms across 93 countries and measured them against local temperatures. She was specifically looking at how temps over 30 degrees Celsius affected overall performance and returns.
We find that on average, an additional day of heat exposure significantly reduces both revenues and operating income.
Let's pause to contextualize what, in Nora's research, heat exposure actually means. It's essentially any day that tops 30 degrees Celsius, regardless of whether that's typical or atypical for a region. This is important because Nora found that any day that tops 30 degrees has a statistically significant negative effect on firms.
For revenues, we have this estimate of decline of 8.4% of an average day's worth of revenues.
Daily operating income, the normalized firm profits less recurring expenses, saw a whopping 26.1% drop when compared to the average day when temps weren't above 30 degrees. The drop of both revenue and operating income meant that the organizational average saw a loss of $650,000 per quarter, which can more strongly hit certain types of industries.
We find stronger effects for firms with higher shares of work outdoors. And we find larger effects on operating income compared to revenues, which isn't ultimate proof, but consistent with the idea that heat both slows down production and provision of services.
That's not to say that largely indoor industries, think factory work, knowledge companies, healthcare, etc., are unaffected. These companies tend to take a bigger hit to their operating income as they pay for AC to cool their workers down. Companies that operate in largely outdoor environments, think construction, drilling, mining, in comparison, are likely to feel a greater hit to their productivity. And regardless, that hit to profit and operating costs doesn't just stop at the balance books. It has a pretty wide-ranging impact, and not just on the company's bottom line. The first trickle effect of this extreme heat is actually on investors.
And we find that when firms were exposed to prolonged periods of heat relative to what is normal for this respective firm, investors are more negatively surprised by their performance.
This likely means investors aren't using temperature data, a widely available piece of information, when speculating on a company's performance.
And this observation would be unlikely if investors tracked firms' heat exposure and adjusted their expectations based on that before the earnings announcement, which we would expect based on the hypothesis that markets are efficient, that information is incorporated as soon as it becomes available. So to some extent, this is a little bit of a puzzle of why investors leave the option on the table of incorporating this information before the earnings of the company are revealed at large.
So investors should probably be taking note of local weather patterns. Heat also has a pretty profound impact on supplier-client relationships, which Nora studied in a second paper released in 2024. Similar to the first study, Nora looked at about 5,500 suppliers and 8,000 customers across 70 countries and measured them against local temperatures as well as other meteorological events like floods.
Climate-related shocks seem to propagate. What I mean by that is that if suppliers are exposed to floods and heat, we do find that naturally their own performance decreases, but also that we see drops in the financial performance of customer firms that are located in different parts of the world. In other words, there seems to be this trickle-down effect that leads to a distribution of the damages from the directly affected firms to the customers in their supply chain network.
It makes sense. Suppliers pass along the cost to their clients. So if things like floods or extreme heat drive up those costs, that will likely be reflected in what they're charging their networks. Clients' other productions are also sensitive to missed deliverables. If a lithium mine in Bolivia experiences a heat wave and subsequently sees a decline in production, then battery manufacturers relying on that lithium have to adjust their outputs as well. And as a result,
the second finding is that suppliers are more likely to lose their customers when these customers perceive that the exposure of the suppliers to heat and floods has increased above and beyond what they expected at the start of the supply chain relationship.
Businesses generally expect some sort of disruption to their supply chain as a result of weather. However, Nora's research found that if a supplier experiences more extreme heat than what they have historically, i.e. the supplier has more hot days than the year before, then the client is 7.4% more likely to drop them from their supplier list. For unexpectedly high exposures, say more heat waves than the previous year, clients are 6 to 10% more likely to replace that supplier with one from an area less exposed to extreme heat. That might be great news for businesses in Scotland, but terrible news for suppliers based in Brazil. So what can companies do to adapt to this heat risk?
Resilience is likely to become a bigger topic connected to the hazards imposed by climate change. So when supplies become less reliable, firms might indeed have to consider multi-sourcing. But there might also be other strategies such as looking for suppliers in less risky locations, or measures such as planning more space for larger inventories, or just increasing lead times in just-in-time production. But for all of these measures, we would expect that these are likely to be quite costly.
Companies, particularly those suppliers who are at bigger risk of losing clients, can also explore heat mitigation strategies.
There are technologies and strategies available to firms that range from very costly to quite affordable, starting with, say, relocating assets and establishments, installing air conditioning, so all on the relatively expensive side. But then the more affordable options might also include rescheduling work hours around temperature peaks and implementing protective protocols for workers. Those are options that are relatively less costly and might be quite effective. However, for all of these investments and strategies, the problem is that they're inherently private and difficult to observe both for researchers but also for investors.
This lack of transparency is problematic. While hits to the bottom line are difficult, it's important to remember that at the heart of these financial losses are the workers, who are likely to be most harmed by extreme heat. And if you and others can't track your investment in heat mitigation, how do you know if it's working? The final study in Nora's heat trilogy looks at how extreme heat affects worker safety. She and colleagues looked at 16 million workplace injuries in California against local temperatures over a 20-year period.
Using this data, we find that heat increases the risk of workers getting injured on the job by about 7.7% on a hot day, quantified as a hot day over 85 degrees Fahrenheit, relative to colder temperatures.
For Canadian listeners, 85 Fahrenheit is roughly 30 degrees Celsius. And for days topping 100 degrees Fahrenheit or 37 degrees Celsius, workplace injuries increased 10 to 15%. And interestingly, this rise in accidents holds true regardless of whether the firm operates largely indoors or outdoors.
We were to some extent surprised how consistent these effects are across all industry groups. For example, we do find that the effects are the largest in, I would say, the usual suspects, as in industries such as agriculture, mining, utilities, construction, where a lot of workers or a large share of workers is indeed outdoors. However, we also do find significant effects in manufacturing and wholesale and retail, in transportation, even in IT, finance, and real estate, and in entertainment, recreation. So really across a whole spectrum of industries, where it is very likely that not all of these injuries just come from work outdoors.
So what's driving these injuries? Well, there's an obvious increase in heat-related illnesses. But Nora observed that it was more than just a rise in heat strokes.
When the body reallocates energy to keeping the body cool, this also leads to impaired cognitive performance. And this can be really detrimental for workers that operate in really risky professions, or that, for example, operate heavy machinery, work at heights, where even a minor decrease in focus can be really tragic.
So while the researchers noticed that, yes, heat-labeled illnesses ballooned, they also noted that other types of workplace injuries grew on days with temperatures exceeding 30 degrees.
It is really tough to correctly attribute these injuries to heat, as in if a worker goes to the doctor or to the hospital with a broken bone, it's very unlikely that that is going to get recorded in the files in any shape or form. But then we also see the same effects in injuries that are not labeled in as heat illness. This category of injuries is much larger, and the effects are very large, essentially attributable to this second effect of impaired cognitive performance.
The good news, according to Nora's findings, is that after California mandated that employers train employees and supervisors on the risks of heat in 2006, businesses saw 1,800 fewer heat-related injuries per year. Considering each on-the-job accident costs businesses an average of $120,000 when factoring in compensation, time off, etc., that's not an insignificant potential savings. And that was with some pretty minor climate adaptive strategies in place. We're really just talking about some basic safety training. Other heat mitigation strategies that Nora mentioned earlier, say increased investment in cooling or off-peak shifts, etc., are also likely to be effective at decreasing workplace injury. But we don't really have the data to support that finding at this time. So extreme heat drives up operating costs, dampens revenue, shocks investors, strains supplier relationships, and can increase worker accidents. Are businesses responding? Well, the short answer is maybe. As Nora mentioned earlier, companies aren't required to report on their heat mitigation strategies, and most investors aren't tracking firm performance against extreme heat. So there isn't exactly much oversight over what companies are doing to protect their workers or profits against rising temperatures. But Nora hopes that companies don't underestimate the extreme danger it might cause.
So I think for heat, there is a high probability that because heat events are relatively less visible or salient, firms might underestimate the effect that these events have on their bottom line. There could be cultural, historical reasons why our understanding of how damaging heat is not that pronounced. So, for example, the discomfort that is caused by heat is often understood as something that we can simply power through or compensate with motivation. I think if we think about what does it mean going forward for climate change, it's a little more difficult to say that more extreme days will necessarily also lead to more damage. I think that's one fair possibility, and it's important to have in mind that these extreme temperatures are likely to be realized much more often. But at the same time, the part that we really know less about is firms' potential to adapt and the cost of adaptation that could factor into the damage going forward as well. Overall, I think over the last couple of years, there has been an uptake in this type of data and analytical work at the firm level. So I think firms will explore this more and more going forward.
This has been Rotman Executive Summary, a podcast bringing you the latest insights and innovative thinking from Canada's leading business school. Special thanks to Assistant Professor Nora Pankratz. Join us next month as we chat with Professor Dan Treffler about why it's so hard to regulate AI, but why we might be hurting ourselves in the long term if we don't. This episode was written and produced by Megan Haynes. It was recorded by Dan Mazzata and edited by Avery Moore-Kloss. For more innovative thinking, head over to the Rotman Insights Hub and subscribe to this podcast on Spotify, Apple, or Amazon. Thanks for tuning in.